So you have an impact of debt levels increasing, real estate values decreasing, the actual yield-like characteristics going away. So that really burned a lot of investors in the real estate space. What we're seeing now in the last, say, year and a half as interest rates stabilize is people coming back to the sector.
When interest rates and inflation spiked after the pandemic, the real estate market was left in the doldrums. Now the sector is rediscovering its mojo as investors look to bricks and mortar for resilience in a volatile landscape. And the recovery march is being led by luxury. With me today to discuss what we can expect from the real estate market in 2026, especially at the top end, are Charles Favard, head of EMEA Real Estate Private Funds Group at UBS Investment Bank, and Saul Goldstein, founder and CEO of pan-European real estate manager ActivumSG, which owns, invests and advises on more than 14 billion euros of real estate. Charles, Saul, welcome to Crafting Capital.
Thanks for having us, Liz.
Yeah, thanks.
So Charles, the real estate market has been on a real roller coaster ride in the past few years. Can you tell us what's been the overriding story since the pandemic?
You're right. Roller coaster is probably the right way to describe what has happened to the industry. And I'll give you a bit of the banker view, and I'll let Saul describe the entrepreneur view. Look, from our side, what we've seen is that you had pre-pandemic and during pandemic very cheap cost of debt, which then fueled a lot of interest for investment into real estate as investors were looking for higher return and dividend than they could get into a fixed income exposure. So post-pandemic, we then in 2022 went into the war, Ukraine war, and as a consequence, we've seen inflation spiking, interest rate then increasing to levels that we hadn't seen in 20 years. And as a consequence of that, we've seen leverage wasn't accretive anymore. So you couldn't use leverage really to invest in property in general. Therefore, we've seen volume of transactions shrinking. 2023 volume were half of what they were in 2021. Right? So as a result, we've seen value in real estate decreasing typically. Some were more hit than others. So if you were in office, clearly that was a big hit because you had your occupational level coming down as well as your cost of debt going up. So this was not a good place to be.
You have COVID, which then creates a demand shock. So offices and other sectors get hit. Then when you have the interest rate rises in 2022, you have the deleveraging effect as interest rates go up. You have asset values coming down, and investors have tended to like real estate for dividend-like, bond-like returns, say 5% a year, which they were getting, and the leverage was accretive, so they were getting nice returns. When the interest rates come up, that spread goes down, and so they're no longer getting what we call a positive carry trade. And so then that also drives down the value of the real estate. So you have an impact of debt levels increasing, real estate values decreasing, the actual yield-like characteristics going away. So that really burned a lot of investors in the real estate space. What we're seeing now in the last, say, year and a half as interest rates stabilize is people coming back to the sector. They're coming back to things like student housing. They like the resiliency of residential. Then you have other asset classes that have operational aspects like hospitality, which are performing really well, particularly in the luxury sector. So people are starting to come back to that as well.
And it feels like there may be a sort of societal shift in that as well. We talked about offices, not as many people going to work or different working patterns, but also there are different patterns among who has the wealth and how they're spending it.
True. So on the office point, indeed, what we've seen is if you were going to start a conversation with an investor with an office offering, the conversation would be very short, right? Because ultimately, investor will tell you they have plenty on their book and they have while there is a portion of the office sector that works, there is a large portion that has its struggle with indeed the change in society where people work more from home, right? So there's been a bit of that. In terms of the shift, as Saul mentioned, that the shift towards operational real estate, okay, we've seen this. I think the key, or the reason for this was that we want to make sure that the manager can drive value. They can drive the top line, they
Right.
can drive the income, they can also be smart around the operational expenditure, how they manage this, and ultimately drive EBITDA, which is much harder to do if you own an office building with a 15-year lease, CPI index, where you're not going to be able to drive the same value, right? So there's been that shift, and also because investors didn't have much of resi, student housing, we've seen that into hotels, obviously. It wasn't a large portion of their book. So they were willing to diversify as well, and with a view to drive EBITDA to a better point.
Well, I think also investor appetite shifted because they had gotten burned in some of these other asset classes, right? The dividend yield, bond-like characteristics that we had described earlier. Once that correlation broke down, they're looking for, well, how do I make money in real estate? And what you turn to is ways to improve the bottom line, as Charles mentioned, through cost cutting, through revenue increases. You can't do that in assets that have, locked in cash flows like an office, right? So they're looking for ways that they can increase profitability through revenue growth and cost cutting. And so hotels is a great example of that asset class.
And we're seeing a lot of people head towards Europe. Is that right?
Yeah, I think, well, there are a lot of reasons as to why Europe has become interesting. I think there's been geopolitical instability, which is changing investor appetite a little bit. There are a number of different key markets. We're sort of across Germany, Spain, Netherlands, Denmark, and some of those markets had been underinvested for quite some time. Spain in particular, and that goes back to post GFC.
So, Charles, and in these countries, in Southern Europe particular, what are the assets that investors are looking for?
Within Europe, they've been looking for operational real estate assets, right? And now that has been enabled by the cheaper cost of capital since 2024. So we've seen rates being cut. Let's not forget that in UK we were at 5% plus. We're now at 3.75 BOE rate. In ECB rate, you were at 4% plus. You're now at 2%. Now, the swap is obviously, given geopolitical um, situation in the Middle East, the swap rates have gone up a bit, but the direction of travel is still the same, where the debt is relatively cheap now, especially in continental Europe, and you can borrow creatively and enhance your return like we used to be able to. And that also has driven momentum towards real estate. So why do they come real estate and continental Europe? Because they can leverage creatively, which is much harder to do in the US, right? So that also is part of the reasoning why we've seen that flow. Now, what do they look for? Hotel and luxury have been a perfect crossway because you have first luxury. We've seen it in our wealth management reports. Uh, the millionaire market has grown by 5% in 25 and 24, which means that on those 2 years you had about 680,000 millionaires, i.e., people that have between 1 and 5 million of net worth. And that cohort is looking to spend, right? So globally, you have about 52 million millionaires that are looking to spend, and that cohort is resilient to, or a lot more resilient to, economic shocks.
I think Europe became interesting also because most investors had a large exposure already in the United States. The United States is the largest market for real estate investing generally. Europe is a patchwork of economies, so it was harder to sort of deploy large pools of capital quickly. But I think the instability gave rise to people reevaluating and looking at Europe. And then within Europe, you have to break it down on a geographical country by country basis. Charles mentioned some of the interest rate benefits of a lower rate in the continent that starts to allow for a positive carry trade again. And then I think you have to look at specific asset classes where you can deliver outsized returns being generated from strong top line revenue generation. And so that sort of dovetails with the point about the increase in wealth. Where are you going to deploy that, and how do you take advantage of that increase in the growth of high net worth individuals? Well, residential is one area, sort of for sale residential. Then the other is operationally hotels. And we've seen that increase in traffic in hotels. We're focused on Spain. There are other markets that are reasonable as well, but Spain has been somewhat underinvested on the hospitality side, particularly in the luxury sector. And there was a lack of penetration by the global institutional brands that had large product offerings. And so there's also a large mom and pop ownership of hotels in Spain. And so that's shifting as well.
Well, tell us about your experiences on the ground
Yeah,
because you
sure.
invest in hotels in Spain.
Yeah, we started looking at this probably in 2016 or so. We've made a number of investments. We started with a refurbishment of an old office building in Madrid. We turned it into a Hard Rock hotel. Of course, it opened at precisely the wrong time, which was at the beginning of COVID. But nonetheless, it was a great project, and it demonstrated the depth of the market. We also turned an old pedestrian sort of a castle in an old pedestrian area in Malaga into a luxury hotel. Um, and then we, during COVID, bought the Nobu in Barcelona, which is both the restaurant and a hotel. And we took the opportunity during COVID to do some value add work because there was no revenue. We took the chance and put a rooftop bar and pool on that, and that has become an incredible destination. And so we're seeing a lot of activity coming into Barcelona. As you know, Barcelona's it's the top conference destination city in Europe, and there are roughly about 100 nights of the year where the hotels are at full occupancy.
So, and Charles, it shows that the luxury retail sector it's not, it's very resilient, but people are spending, not just spending, they're spending more than previously because the wealthy people actually are wanting to sort of enjoy post-COVID, all of it with everything that's happened. We're seeing things moving in that direction.
Look, absolutely. And I think Saul is being quite humble because they've seen the opportunity to invest heavily in Spain and in Barcelona. So I think the beauty of Barcelona is that you have that demand for luxury. You have a lot of people are traveling to Barcelona. It's a go-to location. And the thing is, in Barcelona, you have a moratorium on new hotels. So
Right.
while the guys have been able to, for many reasons, to build, this is the exception. Yeah. Otherwise, you cannot build in Barcelona. And which means that you have that beautiful graph where you have a increase in demand,
Right.
constrained supply, right? And you can read and you have that demand that is not agnostic, but to some extent a bit agnostic to the price point because they want to enjoy themselves and they have the ability to do so.
Yeah, sure. I think you have what Charles is describing is that constraint on supply, right? So it's not a race to the bottom in terms of average daily rates or ADRs. And so there's probably not enough hotel rooms in Barcelona, particularly at the luxury level. So there's a great opportunity to sort of have the brands build their awareness, have an increase in clientele.
And that point, Charles, of constraint is actually across other countries in Europe as well. So for those incumbent players, it's a great situation to be in.
You're right. In big capital cities, historically, it's been quite difficult to develop anyway. So the rules to make a development possible are pretty a big constraint on your development. Two, it's also cost of the development has been up, right? And during 22, 23, there were spikes of your cost of construction. So that deterred a lot of parties to develop. So you had low to no development anyway, right? So I think that has been a good landscape. But some cities like Venice or Barcelona have this addition that is, in any case, you cannot build, right? So that's really I think the beauty of this, where the hotel you guys have.
And that's the problem with development, right? Is you go through these sort of cycles, and these cycles have compressed, as we were talking about earlier. So you get these sort of shocks to the system. So it becomes very hard. And I think the sort of the last couple of years reinforces that problem of being a developer, in that the cycle has compressed. So between the time that you think it's a good time to develop and then you get into the development and then prices go up. I mean, that cycle just keeps shortening. So, and we're seeing that now with the current geopolitical events.
If we can shift lanes a little bit, so every industry talks about technology. It's front of mind for everybody, but how is it specifically affecting real estate?
Yeah, it's an interesting question. Real estate often is slow to be disrupted. Productivity in construction hasn't really increased over the last 30 years. So that's one of the challenges that the real estate sector faces. As it relates to sort of more operational things like operating a hotel, um, technology is playing an increasing role, AI in particular. I think that there are ways to change the patterns of workflow. There are some other areas that we're seeing which relate to how the hotels exist in what I call in what's called the metaverse, and the identification of the hotel and its position. The reality is, if your metaphysical presence isn't strong enough and doesn't adapt to the large language models that are being used by AI, then you don't really exist. So we're seeing a lot of emphasis on that. I think the brands need to do a lot of work. They're actually probably behind where the owners are in terms of the adoption of that. And that just is because, they have a large network and they need to somehow bring this technology across a large network. We're a developer owner of a much smaller pool of assets. So we're on top of these issues. But I think the brands need to catch up a little bit to where the owners are thinking.
I think the beauty in real estate is that AI doesn't replace it, but it can enable better performance, right? And therefore, what we spend time on is to be able to describe to investor how investors like Saul are using the tool to enable better price point, right? More dynamic, better OpEx. We see it in due diligence of investors. They're very keen to understand how you're making sure you use the tools available to you today to drive those so that you can be in the winner camp as opposed to the losing camp.
Well, think about it like what Charles is mentioning about revenue optimization. If you think about pricing and how hotels set prices for rooms, they need to dynamically adjust, right? And so some of the scraping of data allows you to adjust more dynamically and offer different incentives to potential customers in a way that meets their needs, through promotional programs and adjusting prices on a more dynamic basis.
Technology is clearly going to be a dominant theme for many, many years to come. But if we just do a bit of future gazing, looking ahead, and then for 2026, how does the luxury real estate story play out, do you see, Saul?
The picture looks reasonably bright. That said, we have a lot of geopolitical unrest, and hotels reset their prices every day. So I think we're really dependent on macroeconomic factors. We're dependent on geopolitical events. So it's hard to predict. I think the trajectory we were on a few weeks ago, it looked extremely positive. I still think it's overall very positive because there is a demand for travel. There is a demand for luxury hospitality real estate. Um, so I think it's probably a little more nuanced than the answer I would have given you a few weeks ago, but I think it's really bright.
We've seen in the luxury real estate occupancy level going from 70 to 80%, the revenue per room growing 10%. So clearly that sector has been enjoying a lot of the ride, and i.e., a growing population that is wealthier than we used to. And we don't see that trend changing, right? And so if you can combine that with constrained supply, as Saul mentioned in Barcelona, or those type of environment, then you're in a perfect segue where you can enjoy a growth of your EBITDA and profits increase. So I see that direction of travel being still there for the foreseeable future.
Well, this has been a fascinating discussion. Saul, Charles, thank you so much for joining me.
Thanks a lot.
Thank you.
As we've heard, the hotel sector has shaken off its post-pandemic stagnation, led by a flight to quality, a surge in global wealth, and a booming luxury sector. Investors are seeing strong opportunities as travel and hospitality trends increasingly align. You've been listening to Crafting Capital, a podcast series in partnership with custom content from the Wall Street Journal and UBS. I've been your host, Nick Clark. Join us for more episodes at partners.wsj.com/UBS. And be sure to subscribe on Spotify and Apple Podcasts. The content in this podcast was relevant when published. Current views may differ.